Hello guys, welcome back. In today's video, we'll be discussing all about taxes. Like the taxes you pay, the taxes a stockbroker pays, the taxes a market a participant pays, etc. and many more. The tax which we pay, almost which is the most common is income tax, which we pay from whatever income we make. There are many other taxes too, but before giving all those, we should think one thing. Where are these taxes going? What are we paying actually? And how are we being benefited after paying these taxes? So in this video you will see how much tax are we paying according to our income, according to our salary and our annual total annual income, etc. And there are various categories to it. So you will learn all in the coming part. And in the later part we will discuss the tax which are paid by brokers or investors and the people related to the stock market. And you all know India is a country with a very poor tax culture. Only almost 1% of India's population are paying taxes and are properly filing the ITRs, etc. So it is only through sharing knowledge of taxes and we can learn about taxes and we can be properly educated of where we are losing our money. And you all know the richest of the people are not paying taxes, but they're not doing anything illegal. They are just avoiding taxes. They don't want to spend their money, their hard earned money, as taxes, and they are doing it legally. There are many ways to that. But before going into all those, let us understand what is tax. So watch the video, and if you like, don't forget to give a thumbs up and share this video with your friends. Thank you. Keep watching. We will start from the question, what is tax? Tax is nothing but a portion of our earning which you are paying to the government. The next question comes, why? Well, tax is the main source of income for any government because the earning which their citizens are making, they are supporting the government by paying taxes. And why? Because government are providing services like construction of roads, bridges and medical facilities and the defense of our country, etc. Many things are funded with the taxes which we are paying. So we are proudly saying that we are a part of the development of our country by paying our taxes. And now how? The main tax which we all know are income tax, which means we are paying a part of our profit which we are making through our hard work. And that is the most common form of tax which we all are aware about, the income tax. But it is a sad factor that the tax culture of India is poor and only almost 1% of India's population are paying taxes. Well, it's mainly because, as I told you, a lack of knowledge, and a lack of knowledge leads to many unknown factors like unknown frauds like mistakes in filing the ITR, that means the income tax report, and misfiling, etc. So we'll move on. We'll now see how or on what categories taxes are classified. Before moving into the classification based on the amount you receive, we should understand one thing. Who all are supposed to pay taxes? Anyone, any person, a single person or a corporation, whoever is earning something or who is making profit from the transaction like buying and selling are supposed to pay taxes from the profit they are making. And it is clearly defined on how much of the earnings are to be provided, or if they cross this limit, how much percentage of the profit should be given as tax. So we'll move on to that. And you have to know, recently there was a change in this tax slabs. We call it as tax slabs because they are giving a clear definition of a category. So we call it as tax slabs, and we'll see what all are the tax slabs which are currently there. For individuals who are up to the age of 60, they have to pay no tax if their income is under 2.5 lakhs. And if it is 2.5 lakh and under 5 lakhs, then they have to pay 5% of the amount by which their income exceeds the limit of 2.5 lakhs. And if it is between 5 lakh and 10 lakhs, then 12,500 rupees plus 20% of the amount by which their income exceeds the limit of 5 lakhs. And if it is 10 lakh and more, it is 1 lakh 12,000 500 plus 30% of the amount by which their income exceeds the limit of 10 lakhs. This is for the people who are under the age of 60. For people who are more than that, there is another category and their tax rates are different. We'll move to that. For senior citizens, that is from 60 years to 80 years, they don't have to pay any tax if their income is under 3 lakhs per year. And if it is 3 lakhs to 5 lakhs, then they have to pay 5% of the amount by which their income exceeds the limit. And from 5 lakhs to 10 lakhs, they have to pay 10,000 rupees plus 20% of the amount by which the income exceeds the limit. And if it is more than 10 lakhs, they have to pay 1,10,000 plus 30% of the amount by which their income exceeds the limit of 10 lakhs. For people who are above the age of 80, they don't have to pay taxes until their income is less than 5 lakhs per year. And if it is more than 5 lakhs and under 10 lakhs, they have to pay 20% of the amount by which their income exceeds the limit of 5 lakhs. And if it is above 10 lakhs, they have to pay 1 lakh rupees plus 30% of the amount by which their income exceeds the limit. Another interesting thing to note is that if your income is between 2.5 lakh and 5 lakhs rupees, you can claim for a 5% tax rebate, and in effect you are paying zero tax. There is a surcharge for all the above age groups, and it is same 10% of the income tax if income is between 50 lakh and 1 crore, and 15% if the income is between 1 crore and 2 crore, and 25% for 2 crore to 5 crore, and 37% if it exceeds 5 crores. The surcharge is same for all the above age groups. Now take a look at this chart. This is the revised chart with a few changes in the tax slabs. Now let's move into the case of stock market. When you are trading or investing, you need to classify your income under one of these four heads. Broadly speaking, they are: first one, long-term capital gain, LTCG; second, short-term capital gain, STCG; and third, speculative business income; and fourth, non-speculative business income. We will check each of these in detail now. First one, long-term capital gain, LTCG. In India, any gains realized and categorized as LTCG, that is, can be from equity and equity mutual funds, is completely exempt from taxes for the first 1 lakh rupees and at 10% if the LTCG for the year exceeds rupees 1 lakh. Now in the case of equity mutual funds, it is the same, 0% for the first 1 lakh rupees and 10% for the amount exceeding the limit. For a mutual fund should be considered equity based, it should have at least 60% of the investable fund deployed in equity or in shares of domestic companies. But for a non-equity oriented or a debt mutual fund, it is flat 20% on the gain with some indexation benefits. As opposed to 1 year in equity based funds, you have to stay invested for 3 years in a non-equity debt fund for the investment to be considered as a long-term capital gain. If you sell before 3 years, it will become a short-term capital gain. If the investment and the consequent sales were done via an off-market transaction, like buying of unlisted stocks, the tax on LTCG is 20%. An example is venture capitalists buying shares in startup companies and investing in them. The profits they earn, they have to pay 20% tax on those profits. Short-term capital gain or STCG. It is the gain or profit you earned by investing in stocks or equity mutual funds which you held for more than 1 day but you sold it under 12 months of time from the date of purchase. The tax in India for STCG is flat 15% from the profit you made. Next is speculative business income. The simplest explanation is it is the profit earned by trading stocks or equity for intraday and not taking delivery. It is characterized as speculative business income. Next is non-speculative business income. It is the income from trading futures and options of both equity and commodity on recognized exchanges. It is categorized under non-speculative business income as per section 43(5) of the Income Tax Act 1961. So when it comes to paying taxes, business income has no fixed tax rate. You are required to add either of these, which you have speculative or non-speculative, and that to your other income, and pay taxes according to the slab applicable to you. So now let's see what is CBDT circular saying to the stock market people. CBDT is Central Board of Direct Taxes. It now says that an individual can decide on his own to either show his stock investments as capital gains or as a business income, irrespective of the period of holding the listed shares and securities. Whatever is the stance once taken, the taxpayer will have to continue with the same in the subsequent years. So now, since CBDT gives us this permission to decide our trading income as capital gains or business income, let's see what are the pros and cons of declaring trading as a business income. The first advantage is of course low tax. If the total income trading plus any other you have is less than 2,50,000, then there is no tax implication. And now even if you have less than 5 lakh, effectively one has to pay zero tax, as you can avail a rebate if the total income is less than 5 lakhs. Second one is claim expenses. Of course, you have a business, so you will have expenses for that. So one can claim the benefits of all those expenses incurred for the business of trading. While for capital gains, only charges on your contract note other than the STT can be claimed. For example, you can claim for brokerage charges, other taxes while trading, internet, phone, newspapers, depreciation of computers, electronics, research books, etc. and more. The third one is carry forward your intraday equity losses. Speculative losses can be carried over for 4 years if the returns are filed on time. So assume an equity intraday trader makes a loss of 1 lakh rupees this year, but he cannot afford to offset this against any other business the current year. So he can carry forward it for up to 4 years. Similarly, you can carry forward the future and option losses, that is, if there is any net loss any year, that is non-speculative future and option plus any income other than salary, and if income tax returns are filed before the due date, the loss can be carried forward for the next 8 years. During the next 8 years, this loss can be set off against any other business gain. That should be non-speculative. So you can offset the losses with gains. If one incurs any non-speculative future and option trading loss, this can be set off against any income other than salary. Still, it's not always advised to mark your income as business income. There are some drawbacks too. We will see each one of them. The first one is you have a chance of potentially high taxes. If you fall under the 30% tax slab, you will effectively pay 30% of all your trading profits as taxes. It would have been helpful if your profit was under 5 lakhs mark. Next is auditing. There will be a strict requirement of auditing of your accounts, and you should be maintaining a book of accounts which will need to be audited if your turnover goes above rupees 5 crore for a year, or if your profit is less than 6% of your turnover. This is where most of the MNCs fear about their taxations. Auditing is done by a CA, and he or she have to make sure all the accounts are clear so that no future scrutiny may happen. Also, you will need ITR form 3 or 4 as you have declared your business income, and which would mean you need help from a CA to file your ITR returns. For those salaried people who were using ITR 1 or 2, this may be a bit more costly and hectic for them to file. Another type of tax is STT, that is Securities and Transaction Tax. It is a tax which is payable to the Government of India on trades executed on all those recognized stock exchanges. This tax is not applicable to off-market transactions, which are when shares are transferred from one demat account to another through delivery instruction slips instead of routing the trades via exchange. I have told before this cannot be included as an expense. But off-market transactions attract higher capital gains tax as explained before. The current rate of STT for equity delivery based trades is 0.1% of the total trade value. So before finishing this video, I have a quote for you. The first $100,000 is a bitch, but you got to do it. I don't care what you have to do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon. Find a way to get your hands on $100,000. Whose words are these? Do find out and never forget this. And here is a clue. It is the guy in the middle and he's not so very famous, but you know the other two guys. So find out and leave it in the comments. And if you find this video informative, please like and share with your friends and family. Let them also learn about taxes. And if you like my content, do subscribe to my channel. Let's all grow together. And once again, thank you for watching. Keep supporting.